Hello and welcome to CMC Markets Trading Outlook for the week of February the 2nd, 2015. My name is Colin Szynski, Chief Market Strategist. We're coming off a very busy January for world markets, and it looks like February is also going to get off to a very active and potentially a volatile start that could create a number of opportunities for traders. My theme for this week is RBA and Payrolls kick off February. We start off with a flurry of major economic announcements that could have a big impact on world markets. So let's get started with U.S. markets. A lot of the data that's coming out is U.S. related, and in particular, the big numbers we're watching for are the manufacturing purchasing managers indices, which come out on Monday, and this will give us the first indication for many economies around the world and how they're acting going into January. And here on Friday, the 30th of January, we had the U.S. GDP came out for the fourth quarter, and it was below expectations. So now we're wondering, is this a bit of a slowdown in momentum, or is this part of a near-term blip, or is this a deeper slowdown? So we'll look for be looking to January for signs in terms of purchasing managers, as well as the employment data later in the week of, is the U.S. recovery starting to slow? Is the weakness in other parts of the world and the strength of the U.S. dollar starting to catch up to the U.S. economy? Very key questions as we move farther into February. In addition to the PMI and the payroll numbers, which are for the U.S. are ADP on Wednesday and also the non-farm payrolls on Friday. The other big news we have this week is the Reserve Bank of Australia meeting. There's been increased speculation over the last 2 days as to whether they may join the number of other central banks around the world in cutting interest rates. I'll speak to that a little bit later on. So let's begin with some of the action in world indices. We have the U.S. market here. The trade looks overall, the U.S. indices seem to be leveling off, but interestingly enough, we're seeing that also here in the index. We have both in terms of number of clients and position of value for top clients, 59%, 56% long. That tells us that overall there's a bit of a split here now. People aren't quite sure which way the markets may go, although we do see a little bit of optimism still. We'll look at the chart here for the S&P 500. Shows us that what we're seeing is after a sell-off in September, October, a big rebound that went into December, we're basically starting to go sideways for U.S. markets. In the case of the S&P, we've got a channel forming between about 1970 with some additional support near 1990, and then on the high side, resistance in and around 2070 to 2100. And this sideways channel is emerging. It's hard to tell at this point if this is a head and shoulders top or if this is just the beginning of a sideways trading range. Looking down here at the RSI, we're also getting mixed signals. We're basically getting a big symmetrical triangle of lower highs, higher lows, and it's been going back and forth between 40 and 60, suggesting sideways or neutral momentum is emerging in the S&P 500. And if we bring up the US 30 here, we'll see the same kind of patterns appearing as well. In the case of the US 30 here, it's 17,100 or 17,000 as the support zone, and up at the high end, 18,000 to 18,100. Again, we're seeing lower highs and higher lows, but overall, the channel here, and we can see it more clearly in the RSI swinging between 40 and 60, has basically been going sideways for the US 30. The down in the support zone, well, only do we have prior lows, we've got a Fibonacci test at 17,000, a round number, and up closer to 17,100, we've got the 200-day moving average. So that looks like pretty good support down here. Initial upside resistance, 17,500, and then 17,600 for the US 30. The moving now away from, so the big things we're watching for with the U.S. once again, the purchasing managers, which come out Monday for manufacturing, Wednesday for service. Wednesday is also the ADP payrolls, and Friday is non-farm payrolls. So those are the main things we'll be looking for the U.S. during the week. Plus, throughout the week for the United States, we'll have earnings reports. It's we do have a beginning of the week. We kick off with energy. We have ExxonMobil reporting on Monday. The really big day for U.S. earnings is Thursday afternoon, a huge day for technology earnings. We have results coming out from Twitter, Pandora, LinkedIn, Symantec, and Activision. That will give us a good idea towards the end of the week of the appetite towards momentum plays and technology stocks. The next big thing we're looking at this week is in currency markets, and particularly in resource markets, and that surrounds the Reserve Bank of Australia meeting. We've seen a pretty big slowdown in commodity prices, certainly big sell-offs in coal, in copper, and in oil prices over the last few months, and we have seen some of the central banks respond to that. So we had Norges Bank and the Bank of Canada both cut interest rates in the last 6 weeks, and they're both, however, more heavily weighted to oil. The Reserve Bank of New Zealand decided not to cut interest rates. They instead decided to have another go at talking the dollar down, and they were certainly successful in doing that. So the question now is, as we go into the RBA meeting, is are we going to see them cut interest rates? They certainly have room to do so should they wish, or are they going to take the approach of trying to talk the dollar down and possibly even threatening to intervene in forex markets? That remains to be seen which route they'll go, but we have had quite a sell-off in the Aussie dollar heading into this particular meeting. So I just wanted to highlight here the market sentiment towards the three big resource dollars here. We have the Canadian dollar, the Kiwi dollar in the middle, and the Aussie dollar here on the right. And as we can see, overall, clients are pretty short all three of them. Even though they've been sending downward, their downward trends have been intact, and people are clearly thinking that there could be further weakness from here. So I will highlight these $3 on the charts. The Canadian dollar, by the way, the two big announcements for Canada, really the main one is the jobs report, which comes out on Friday. Also, we do get purchasing managers numbers for Canada during the week and producer prices, but the main focus will be on the labor force survey, which comes out on Friday, 8:30 a.m. Eastern Time, same as the United States. Canada's GDP, by the way, also came in below expectations, and that has been knocking the loonie down here to wrap up a January as another really rough month for the loonie. So we'll start here with the Australian dollar, which I will bring up right here. And what we're looking at here is, as we can see, we're declining in a pretty big step pattern where we have a sell-off, consolidated lower level, sell-off, consolidated lower level, sell-off again. Well, now we've broken 80. We've continued to trend lower for the Australian dollar. A little bit of supports coming in this 77 to 78 area, and we do have an oversold RSI, so maybe we get a bit of a trading bounce here, perhaps up to 79. But this $80 round number break was pretty substantial, and I do think this has signaled another down leg that potentially could carry us back down towards the 75-cent level over the longer term. Maybe short term you get a bounce, but it certainly seems longer term as though this wants to trend down towards this 75-cent round number. Keeping that in mind, we're now going to take a quick peek at CAD US dollar. I think that the Canadian dollar and the Australian dollar are trading around parity, and they may continue to do so in the coming months. Similar to Australia, Canada recently broke the 80-cent level. It's traded down to about 78, could bounce up to 79, maybe 79.20, but overall there is a potential that this also could fall back into the 75 to 76 area. In both cases, we do have oversold RSIs on these dollars, so you could get trading bounces come out of nowhere on short covering or bargain hunting, but the primary trend remains downward for both at this point in time. We'll also bring up the Kiwi dollar here to highlight. It's running a little bit lower. It's broken 75 already, and is trading down towards 72, 73. In this case here, a rule out of the 70-cent round number can't be ruled out at this point in time, and certainly appears possible, although in the very short term we could see it level off here, maybe bounce up towards 74. 75 has now become resistance for the Kiwi dollar, just like 80 has for the Australian and Canadian dollars. The other central bank meeting we do have this week is in the UK. No major changes are expected from the Bank of England this week. However, that being said, what traders do appear to be looking at with a weakness in sterling lately is that perhaps the Bank of England may continue to back away from. It stands. Originally, people have been looking for it to raise interest rates this year. With the weakness in Europe and other factors, it does appear as though they may not raise interest rates this year, or if they do, it'd be much later in the year. So we keep an eye out for any signs from the Bank of England on that, and I'll bring up the chart here for cable, which shows us that it's down here again, bumping up against the bottom of this 150 to 152.75 trading channel. Another one where it's in a pretty steady downtrend with the occasional sideways consolidation. We are, however, getting a bit of a positive RSI divergence here, so it does seem as though some of the downward pressure is falling, but we could easily see it peak under 150 a couple more times just to see if they clean out any stops or shake out any other weak hands. If it did break, you could see it come down maybe around the 147.25, 147.50 area. I'll take a quick look at Europe as well. Although there isn't as much economic or central bank news out of Europe, you could see some markets get knocked around a little bit on the continuing fallout from the Greek election, where now that the election's over and Syriza has won and has a majority coalition that they're in and getting serious about delivering on their promises. So we are getting to a point where Greece and Europe may be getting into a renegotiation phase, and that raises uncertainty. So we have seen some markets drift back a little bit in Europe. It's at this point, it's less about downside and more about capping the upside. But of course, we do have to watch for risks here. The DAX had a pretty good run here after it blasted off above 10,000 and cleared 10,200 and kept right on going. It now seems to be leveling off here in the 10,575 to about 10,875 trading range here. Our RSI is overbought. Kind of a bit of a head and shoulders here, but more importantly, a lower high at 70 has failed now, so we could be getting into correction mode. If we do, then first support around 10,575, and then this 23% retracement level in and around 10,475. And now if we flip over and take a quick look here at euro dollar, we'll see that, I mean, it's been hammered pretty hard, but now the news from the ECB is out, and we know how big the stimulus program is going to be, and now it's just a matter of everybody waiting for it to actually start in March. Because we're in a lull period here in February, we could see this level off for a little while. It is pretty oversold down here on the RSI. May take some time to work that off. So we've got an initial support here around 111. There's a round number at 110. It's actually trying to level off in close to 113.50 with some more resistance up here around 114.20, maybe the 115 round numbers. So somewhere between 110, 111 in the lower boundary, 114, 115 in the upper boundary. We do seem to be setting up for a bit of a sideways consolidation like we had through November and the first part of December. We'll also take a quick look here at gold and oil, two markets that have been quite active over the last few months. First of all, on client sentiment, our clients right now are currently quite long on both. Some of the long positions on gold have been trimmed back a little bit. I think that's primarily because you had such a good run here. We're also seeing some of the long positions getting trimmed back on crude oil. It's struggled. It's had a hard time showing any kind of a rebound, and because of that, I think some clients may be starting to think that perhaps the sell-off isn't completely done in crude oil. So let's take a look at the charts here. We'll start with the gold chart, which we'll bring up here. And as we can see, we had a pretty good run up for gold, peaked above 1300, got overbought on the RSI. We've seen it retrench a little bit back toward 1275, some more support in around the 1250, 1255 area, and more. The breakout point was around 1235. But overall, gold's been having a pretty good run inside day here on Friday, and looks like it's just kind of consolidating and digesting some of its recent gains. But so far, its uptrend remains intact. If we look at crude oil, WTI here, we'll see that even though it's sold off and has remained in the downtrend, there hasn't been much enthusiasm in terms of a rebound. It hasn't gotten anywhere near 50 in quite a while, and it only peaked above it one day, and then got hammered back down after breaking 50 in the first place right at the beginning of the year. So overall, it's still kind of drifting lower. Yes, we do have a positive RSI divergence, which suggests that the downward pressure may be easing. Maybe it levels off into a 44 to 46 or 44 to 48 range. But if it does start to break 44, then we could easily see 42 or perhaps even the 40 round number for crude. That can't be ruled out, although in the short term, it does look as though at least trying to continue to stabilize and do a bit of base building here. Just the last thing I wanted to mention, it is in terms of earnings, a lot of the big names have come out and reported already, but we do have a few of the mid-tier names and a few technology names still reporting. A couple in particular that might attract some attention from traders is we'll look at Twitter, and I'll look at Pandora just briefly here. We'll look at Twitter. Has certainly had its ups and downs since its IPO. Big rally, big sell-off. Big rally, big sell-off. It's basically bottoming out here in a channel between about, say, 34.25, say 35, and 40 to 41. On the upside, it's been going sideways. Similarly, RSI back and forth between 40 and 60 suggests this is going sideways, but we could see some movement in one direction or another off of the earnings report. And we'll also keep an eye on Pandora. The Netflix actually ended up having a really good quarter, and its stock did pretty well following its earnings report here. Just keeping an eye on Pandora. It's drifting lower. It does seem to be trying to catch some support here, though, in the about 15 to about $18 range. It's trying to level off a bit here. And we're seeing that the RSI has also been breaking out of a downtrend and starting to look up a little bit. So we have seen certainly a very volatile and active January for trading. February certainly looks like we may continue to see a lot of trading action as with mixed sentiment and a lot of mixed signals out there. We're working through a big transition phase now where we've had an oil price crash, and so that can have some negative short-term effects but positive long-term effects for many economies. But as we work through this transition, we could still see some volatility, which may create opportunities for traders.